When it comes to mortgage rates, an interest rate cut doesn't always mean lower payments. Jason Wheeler breaks down what really drives mortgage rates and how you can still save big.
A true story here. One time I had just wrapped up what had been a nice meal of Chinese food, and I cracked open my fortune cookie for my special message. Would it encourage me or extol my virtues? Maybe tell me how prosperous or lucky I'm about to be? Or might it just be a totally blank little slip of paper? It was that one. Total disappointment. But not as bad as this fail. The mortgage rates you are hoping will plummet just because of an interest rate cut by the Fed may not go down like you think. Okay, first of all, that's way too much message for a tiny piece of paper. Second, no one wants to read that, even though it may be true. Hoping to save a fortune, 76% of potential home buyers surveyed by U.S. News said that they put off buying a home last year waiting for mortgage rates to fall. And so many people watched the Fed thinking that when they finally begin lowering interest rates, mortgage rates will follow. But that's not really the way it works. The Fed manipulates the federal funds rate, which is the interest rate that banks charge for overnight lending to other banks. That kind of loan is extremely short term. Mortgages, which are paid back over a 15, 20, or 30-year period, need a benchmark that is much longer than that, so mortgage rates are tied to the yield on the 10-year Treasury note, which is a much longer-term investment. And that yield generally goes up when investors see strong economic growth ahead, and it goes down when they see economic uncertainty or suspect a slowdown ahead. Now, you can see it here, how the 10-year Treasury yield goes, so go mortgage rates. On the contrary, you can see multiple examples over the years that when the Fed cut short-term interest rates, mortgage rates didn't necessarily follow. That being said, mortgage rates have been coming down in recent weeks and are now at their lowest levels since October of last year. And Texas-based Frost Bank sees a lower mortgage rate environment as we approach year's end, so they tell me they have preemptively lowered their mortgage rates by 0.5 percentage point now. 0.5% doesn't sound like a lot, but with a long-term mortgage, that can be significant. Look at a $350,000 loan at 6.5% versus a 6% rate. The monthly payment for the 0.5% lower rate is $114 less, and the interest you would pay over the life of the loan is almost $41,000 less. Now, here's the thing. The average mortgage rate has fallen by more than that this year. If you took out a $350,000 mortgage at the lowest average rate this year, which we just hit, versus at the high point back in January, your monthly payment is $160 less, and the interest you would pay over the life of the loan is almost $58,000 less. Now, even though they're not directly tied to interest rates, will mortgage rates keep going down? We don't know future fortunes regarding that, but we do know this: always follow best practices and follow @JasonWheelerTV on Facebook, Threads, and Blue Sky to stay right on the money. That's another way too long message.